the LCM is going to be like 18 years, so that's quite cumbersome. So let's use the present worth analysis instead. So option A is 6 year, right? So as we mentioned earlier, the common approach that we need to do is we draw the cash flow diagram first. So this is time 0, 1, 2, 3, 4, 5, and 6. And then the first cost is 1,500 and annual cost is 305,000 and deposit return is 1,000. So you have 15K here, and each year you will have to pay 3.5K. These are the same. So this is 3.5K, and then deposit return as 1,000. And option B is first cost is 18,000 and then 3,100. Deposit return is 2,000 and term is 9 years. So this is the picture for option B. So this is the first cost as minus 18,000, and every year you have annual cost of 3,100, and then the return is 2,000. So annual worth of option A is, first of all, you will see the 3.5K is already annually, right? So we don't need to touch anything about this annual cost, but these two are the one that we need to take care. So I have 1,500 at time 0, and then I try to bring back this 1K back at time 0 first, then distributed over 6 years. I will do like this. This is going to be like plus 1,000 minus 1.1 off. I is 15%. Sorry, I is 15%. So divided by 1.15 to the power of 6. So what I try to do here is I already have 15K at time 0. I have 1K at time 1. I divided this 1K by 1.15, which is 1 plus I to the power of 6. In the sense is bring back this 1,000 to time 0. And then I would like to distribute it over 6 years. Therefore, I divided by 1.15 to the power of 6 minus 1 divided by 0.15, 1.15 to the power of 6. What I did here is I use these factors. So in other words, A is equal to P divided by 1 plus I to the power of n minus 1 divided by I, 1 plus I to the power of n. So I divided this whole thing by these factors as this, the entire thing here is present value, right? I divided this to make annual value, and then I have minus 3,500 as annual payment. If everything I have done is correct, this final value is minus 7,349.32, 7,349. So this is the first option's annual worth analysis. The second option, alternative B, is I have 1,800 as a first cost, then I have 2,000 that I received back in year 9, so I have 2,000 divided by 1.15 to the power of 6. Bring that 2,000, this 2,000 back to period 0. Then I divided this whole thing by 1.15 to the power of 9 minus 1 over 0.15, 1.15 to the power of 9. The entire thing here that I did it here is, first of all, I bring this 2,000 2k back to time 0 by divided 2,000 by 1.15 to the power of, sorry, this should be power of 9. I divided 2,000 with 1.15 to the power of 9. In a sense, is I bring this 2,000 back to time 0, and then I divided by these factors. As I did it, it's the same thing that I distribute the present value throughout the 9 years of period. And then I have annual cost, which is 3,100. And if I did it correctly, you will get minus 6,735.18. Therefore, since B is greater than A, select option B. So I will highlight as B. So the green one is 1.15, which is here, and then the pink one is 1,000, and then the yellow one, which is the 3.5k, is this one. I said it, I bring this thing back to time 0 by divided by 1 plus I to the power of n, and I divide by this factor to distribute it over the 6th time period. Same logic is here. This yellow is 3,100, this 2k is this 2k, and this one 1,800 is this 1,800. So, do you have any questions? So I think I upload the clear solution in my course view already. And last time we did this approach as well, that instead of using annual worth analysis, we use the present net present value analysis. So I will not repeat it now, but the same idea is the same. So because the lifetime is not equal, therefore you need to find LCM, and LCM is 18 years. So the logic is you repeat the same process 3 times for option A, because the life cycle is only 6 years, and for option B is you need to repeat it twice because the lifetime is 9 years, and you calculate all the same logic that we have done before. Any questions? So, application of annual worth, we can categorize the cash flow as initial investment, salvage value, and annual amount. These are the same thing that we have taught. So you have initial investment, for example, 1,800 or 1,500 in the example. You have salvage value or deposit return, which is 1 or 2,000 in our example, and you have annual amount that you need to pay annually. So if you draw a picture, it's going to be something like this. So you have timeline, right? You have time 0, 1, 2, and then it's go on until time n. You have initial investment P, which is this one. You have salvage value, which is S here, and each year you will have the annual amount, which equal to A. Initial investment is the total first cost of all asset service required to initiate the alternative. Salvage value is terminal estimate value of asset at the end of the useful life, and annual amount is equivalent annual amount of all recurring and non-recurring receipt and cost other than P&S. So basically, that's our definition. For example, if you buy a machine, you have initial investment, right? You need to buy a machine. Every year you have maintenance cost. Initial investment, you buy a machine, that is P. And every year you have maintenance cost, that is A. And after maybe like the useful life, maybe 20 years, the machine is not work properly at all, and you need to sell it. You sell the salvage, you sell the remains of it. You get some money back. That is S, which is salvage value. And that is annual worth analysis. The application of annual worth analysis, this is quite what should I say? It's quite simple in the sense that maybe everyone, when you work, are not studying the engineering economy. Therefore, you might need to have some common words to talk to others. So the concept of capital recovery is the equivalent annual cost owning a productive asset plus the return on the initial investment over n period at the rate of I per period. So basically, capital recovery or CR is equal to you do not consider the annual expense at all. You consider only P and S. And the capital recovery is the minimum amount of money and investment must return each n year to recover the initial at a return of MAR. The CR is the return per year that you need to receive in order to cover the initial investment. The reason is the purchase of asset to conduct business involve a commit of the owner fund and over a period of time. Does owner expect return on investment? CR does not include the equivalent annual cost, so you consider only P and S. So you see an example that's gonna be easier. One of the machine is expected to require an initial investment $13 million with $8 million committed now and the remaining $5 million expense at the end of the first year one of the project. Annual operation costs, AOC is annual operating costs, are expected to start at the first year and continue 0.9 million per year. The useful life of the equipment is 8 years with salvage value of 0.9 million. Calculate CR and the AW value for the equipment. MAR is 12% per year. So first of all, you need to translate these whole things into the cash flow diagram. So you have the 8 million at year 0, right, and 5 million at year 1, because the total amount is $13 million, but you has the installment. The first installment is $8 million and the second one is $5 million. So you translate into this picture. So you have first payment $8 million and second payment of $5 million at the end of year 1. Annual operating cost is $0.9 million and salvage value is 0.5. In the example, it will give you the MARR equal to 12%. So these are all information you are get from the description. First of all, let's calculate the capital recovery. The capital recovery, you consider only the initial investment, which is $13 million, and salvage value which is $0.5 million. Let me consider the initial investment first. So I have minus $8 million, right? And I have minus $5 million at year one. This is the two things that I have. But the $5 million is happened at the end of year one. Therefore, I need to convert into the present value first. Therefore, I need to divide it by 1.12. Right? This is the initial investment. And I know that I just got this thing. P is equal to A multiplied with 1 plus I to the power of n minus 1 over I 1 plus I to the power of n, right? I need to convert the present value into the annual value. Therefore, I need to divide it by 1.12 to the power of A minus 1 divided by 0.1 to 1.12 to the power of A. This is the P, right? The whole thing, this whole thing. This came from this. And this is P. And this is P. Right? The remaining thing is the salvage value, which is S. And this is plus $0.5 million, right? For me, the easiest thing to do is I bring it back to time 0 first. Therefore, I divide it by 1.12 to the power of A in order to bring this salvage value to present to the time 0. And then I divide it by the same factor, which is 1.12 to the power of A minus 1 divided by 0.12, 1.12 to the power of A. And this is S. And if you calculate correctly, you will receive the final value as minus $2.47 million. And this is capital recovery. Which means that during the useful life of this project, consider only the initial investment, the return that this machine needs to give us is at least $2.47 million per year in order to cover the initial investment. And the question also asks about annual worth as well, which is easy because we calculate capital recovery as 2.47 already, and it has the annual operating cost as 0.9. So therefore, the annual worth is minus 3.37. Okay, I will have another 2 examples of annual worth analysis, and then I will wrap up the sections of annual worth analysis and go to another section of initial rate of return. So the example of Pizza Ranch will not be covered. It's beyond the content that I will cover in this lecture because you will see that it has growth rate. So if you draw a picture in the Pizza Rush example, if you have growth rate of the $15 per year, and that's not covered in this engineering management class, so you don't need to worry about the growth rate. But if you're interested or you read the engineering economy textbook, there's another symbol or another variable is considered as well, and that variable is G, which stands for growth per year, but we are not covering that in this lecture. What's more interesting is this one. Which plan is better at NDR at 15%? You have two plans. Plan A is basically this is just the material handling project. You have the project that you have to authenticate to implement the material handling project in the manufacturing plants. The first one is plan A. You have mover and you have pad. And the plan B is use conveyor. And note is when you use plan A, both mover and pad are required. So, but that's not a big deal. So, if you use the annual worth analysis, let's use the annual worth analysis for plan A. So the picture is something like this. This is year 0, 1, 2, 3, until year A and until year 12. So the mover which I use the green symbol is the first cost is 90K, and then annual operating cost is 12K, and salvage value is 10K. And the pad is first cost is 28K. Annual operating cost is 0.3K. And salvage value is 2K. Oh, sorry. But pad is until year 12, and the salvage value is 2K. It's something like this. Plan B is you have the same timeline, but this time is 24 years. You have year 0, year 1 until year 24. Initial, so this is 3, this is red, and this is purple, let's say. 175K as initial investment, and AOC is 2.5. This is 2.5, and salvage value is 10K. So, from this information, from the information in the table, you can convert it into this picture. Therefore, the annual worth of option A the annual worth of option A is come from, basically before we moving on, you will from from this example, the example about the capital recovery, you will see that the annual worth is equal to capital recovery plus annual operating cost, right? Basically, that are the same thing. You can do either way. I say again, the annual worth is equal to the capital recovery plus annual operating cost. Therefore, in this example, you will find the annual worth of option A is annual worth of mover plus annual worth of pack, right? And then annual worth of mover is equal to capital recovery of mover plus AOC of mover. Then you plus capital recovery of pack plus AOC of pack. And basically AOC is given already. So what we really need to do is we find the capital recovery of mover and pack. Capital recovery of mover is equal to the minus 90K, right? And then plus 10 divided by is equal to 15%. Divided by 1.15 to the power of A, right? And then I divided this whole thing by 1.15 to the power X minus 1 divided by 0.15, 1.15 to the power of A. Keep putting note here is P is equal to A multiplied with 1 plus I to the power of n minus 1 over 0 over I 1 plus I to the power of n. And this factor is exactly the same as this factor. And still need to minus 12. 12 is from this 1,200. And then I minus the capital recovery of PAC, which is minus 28 plus, plus 2 divided by 1.15 to the power of 12 divided by 1.15 to the power of 12 minus 1 over 1.15 to the power of 12. So I did the same thing. That I calculate the capital recovery of mover, which is here. I calculate the capital recovery of pack, which is here. This is the AOC of mover, and AOC of pack is minus 0.3. And if I calculate correctly, you will find that the annual worth of option A is minus 36,724. This is the annual worth of option A. And annual worth of option B is equal to capital recovery of option B, right? Plus AOC of option B. And that is equal to the minus 175K, which is initial investment of option B, plus 10 divided by 1.15 to the power of 24, which is the salvage value discount back to period 0, and then divided by the factors that make it as annual worth, which is 1.15 to the power of 24 minus 1 divided by 0.15, 1.15 to the power of 24, and then minus 2.5, which is AOC of option B. And then you will get as minus 29,646 as the annual worth of option B. Therefore, you select option B rather than option A. The concepts are the same, right? Even though you have multiple sub-choice in the options, you need, as long as you calculate the annual worth analysis, you don't need to calculate AOC or anything. It keep repeating all over the time. For an application of public infrastructures, in this example, we will go deeper because when you are working on something that is public infrastructure, for example, building bridge or something similar, that their useful life is very, very long. The annual worth is much more, I would say, easier because you know that P is equal to A multiplied with 1 plus I to the power of n minus 1 divided by I 1 plus I to the power of n, right? Let me write down. You know that P is equal to A multiplied with 1 plus I to the power of n minus 1 divided by I 1 plus I to the power of n. This is what we have derived before. Right? And of course A is equal to P multiplied with I 1 plus I to the power of n divided by 1 plus I to the power of n minus 1, right? These two are equal. I mean, this is just, I just change the factors, move the factors to the another side. And if you are consider something that lasts very long, it will affect, what will be affect in this formula? Basically, your n, your number of years, number of useful life, it goes to infinity, right? And therefore, because n is go to infinity, 1 plus I to the power of n and 1 plus I as n go to infinity, 1 plus I to the power of n is very close to 1 plus I to the power of n minus 1, right? Let's say n is million, 1.15 to the power of million and 1.15 to the power of million minus 1 is very close. Therefore, these two are approximately the same as n go to infinity, and therefore A is equal to P multiplied with I. Right? And this is exactly what I wrote here. So what I wrote here is, for application in the public infrastructure project whose life is assumed to be very long, we will perform annual worth analysis for the permanent investment. Annual worth of initial investment is equal to perpetual annual interest earned on the initial investment, where I is the decimal, not the percentage. So this is very intuitive equations. But the question is, if we are consider the project that is very useful life, very long, and you try to calculate the present worth analysis, that's going to be very difficult, right? You need to do the infinite sum formula and so on and so forth, and that's emphasize what we have taught in the earlier in this lecture is that using annual worth analysis has two benefits, and I very emphasize on this so you know what's happened. First, it's easy to calculate. Either you don't need to use LCM at all, or it can be used to calculate something that lasts very long. That is the first benefit. The second benefit is it's easier to communicate. For example, this is I think this is a last example of the present annual worth analysis. For this permanent project, which plan is based according to AW analysis, assume that interest rate is 5% per year. For plan B, is require additional $3,000 repair cost every 5 years. So you have 3 plans. The plans A and have 10 years of life, useful life. Plan B, you have permanent useful life, but every 5 years it will be $30,000 repair cost. And plan C, useful life is 50 years. So as usual, we will draw a cash flow diagram first. Plan A. You have this cash flow diagram as 10 year 0, year 1 until year 10. Initial investment is 650, and then AOC is 170. Until year 10 is 170, and salvage value is 17K. Hopefully you can convert the description into the cash flow diagram. Plan B, you have permanent useful life. The initial investment is 4 million. This is 0 and this 4, keep going. It's 4 million, so this is 4,000K. And AOC is 5,000. Initial investment is 4,000K. And AOC is 5K. And every 5 years, you will have additional 30K for the repair cost. At year 5, at year 10, it's another 30K. And keep going. The picture can be something like this. And plan C, initial investment is 6 million and useful life is 30 years and AOC is 3K, 3,000. Note that the option B and option C has no salvage value because it's very long. So the useful life is very long. So for options C, you have 0 and it's going into year 50. The initial investment is 6,000K and AOC is 3K for every year until year 50 is 3K. So this is a conversion of the description from the problem into the cash flow diagram. I is equal to 5% as given from the description. So calculate the annual worth of option A is simple because this is it's actually the same thing that we have done so far. So this is capital recovery of option A plus AOC of option A. Capital recovery is minus 650K plus 17K divided by 1.05 to the power of 10, and everything is divided by 1.05 to the power of 10 minus 1 divided by 0.05, 1.05 to the power of 10, and then plus 170, minus 170, and that is equal to minus 252.8, $252,824. Again, so I calculate the capital recovery from the salvage value and initial investment, and this minus 170 is the annual operating cost that happens throughout the year. The option B is annual worth of option B is capital recovery of option B plus AOC of option B. The capital recovery of option B has only $4 million, right? That is minus 4,000K basically divided by 1.05 to the we can do that as well. Basically, if you forget about the formula, you can do it the same thing. It's 1.05, but you will notice that its n is going to infinity, right? Minus 1 divided by 0.05, 1.05 to the infinity. And these factors are cancelled out anyway. So it's going to be easier that, and you will see that this 0.05 will finally multiply with 4,000K. So in the final capital recovery, you will get 4,000 multiplied with 0.05. This is the initial investment of the option B. Then AOC of option B has two terms, right? You have minus 5K that's given from the description, and you have another 30,000K from the description that happened every 5 years. What we will do is the same logic that you bring back this 30,000 to times 0 by divided by 1.05 to the power of 5. It's exactly the same thing that you bring this 30K back to times 0 and then you distribute it back throughout 5 years period, which is divided by 1.05 to the power of 5 minus 0.05, 1.05 to the power of 5. And that is equal to minus $210,409. And plan C, you have annual worth of option C is minus 6,000K plus 50K, which is salvage value, divided by that 50 is not salvage value. It's year 50. So the annual worth of option C is only $6 billion divided by 1.05 to the power of 50 minus 1 divided by 0.05, 1.05 to the power of 50, and then minus 50 or minus 3, right? And that's equal minus 3,334,680. So all of this, I think what I wrote in the solution is like wrong. I forget the annual operating cost. So this should be correct. So anyway, you will select option B rather than option A and C because it yields the lowest annual worth analysis. So to wrap up, annual worth analysis is better than present value analysis because it's easier to calculate and it's easier to communicate. I think the concept that will go follow this is going to be like relatively easy and short rather than compared to the one that we have discussed so far. So the next thing is initial rate of return. That's going to be like something interesting as well. The initial rate of return or IRR is a metric used in financial analysis to estimate profitability of potential investment. IRR is a discount rate to mark the net present value of all cash flow equal to 0 at a discounted cost flow analysis. And IRR is annual return that makes annual NPV equal to 0. Basically, if you want to calculate IRR, if you want to calculate IRR, it's the same thing that you want to find the discount rate or interest rate that make net present value equal to 0. Say it again. In order to calculate IRR, basically you need to find interest rate or discount rate, the same thing, that make net present value equal to 0. And that is what I wrote here. The formula to determine IRR is NPV. You want to make NPV equal to 0. You want to make NPV equal to 0 and find this IRR. Let's see the example and you will be very clear. Let me draw a picture here as well. So, for example, if you have timeline like this, and you have the initial investment at year 0, right? 1, 2, 3, 4, 5. Let's say project has lasted for 5 years, and you have return high and low like this, right? You have, this is F1, F2, F3, F4, F5. You want to find the I that make this net present value equal to 0. Basically, this is minus P plus summation of Ft divided by 1 plus I to the power of T equal to 0, and this is exactly the same that I wrote in the left hand side. But you will see an example and that's much more easier. The core concept of IRR is basically it will tell you the return of that project per year. Period. Say it again. IRR is the concept to calculate the return of the project per year. So if IRR is greater than NARR, hopefully you can remember NARR, right? If IRR of that project, the return of that project is higher than minimum acceptance rate of return, that means that project is financially justified. Right? Say it again, because IRR is the return of the project. If IRR of that project is higher than MARR or minimum acceptance rate of return, if IRR of project A is higher than MARR, it means project A is financially justified, right? Because MARR is the lowest possible acceptance rate of return. It is a minimum acceptance rate of return. Minimum acceptance rate of return. Therefore, if the return of the project is higher than minimum, the project is financially justified. If IRR of project B is equal to MARR, is indifferent, right? It's just equal. It's like if you have better options, you choose better options. If IRR is lower than MARR, that is unjustified. Because except it is like security law or other exception. But if we are talking about investment, if IRR is lower than MARR, is unjustified investment. We are not talk about Excel calculation in this course. Initial rate of return. Generally speaking, the higher IRR, the more desirable an investment is to undertake. IRR is uniform for investment of varied type and as such can be used to rank multiple prospective investment of project. In general, when compared investment option with other similar characteristics, the investment with higher IRR probably would be more considered the best. What I try to say here is better IRR is better options. Higher IRR is better options, and it's like project is uniform. Is the fair comparison between project and project. Applications of IRR. In capital planning, one popular scenario for IRR is comparing profitability of established new operation with the expanding existing operations. So, what I try to say here is, if you have two options, as we mentioned, IRR is, higher IRR is better options, and IRR is fair comparison. Therefore, if you have two options, either expand your existing manufacturing plants or establish a new one. You calculate IRR for these two options and compare. You don't need to compare other things else. IRR will be the one that make decisions. For example, an energy company may use IRR to decide whether to open new power plant or to renovate and expand the existing power plant. While both projects could add value to the company, it is likely that one will be the more logical decision as prescribed by IRR. Note that because IRR does not account for changing discount rate, it's often not adequate for large or for the longer term project with discount rate that are expected to be varied. So what I try to say here is IRR is fair to use, but if the project is last very long, the discount rate might vary, so you should take that variation into the picture. IR is useful for corporate to evaluate stock buyback program. Clearly, if a company allocates substantial funding to repurchase its stocks, then the analysis must show that the company owns stock is better than investment. It has higher IRR than any other use of funds, such as creating new outlets or acquiring other companies. So that's the another application of IRR. In the company, they have always has an options every year that either you have basically the company has profit, right? And how they use that profit. The first option is you reinvest. You open the new store, you invest in your project, and so on and so forth. That's the first option. The another option is you buy back your stock from the shareholder, and you need to compare these two IRR, which one has the higher IRR. That would be the more favored options. Individual can use IRR when making financial decisions, for instance, when evaluating different insurance policy using the premium and death benefit. The general consensus is that policy that have same premium and higher IRR are much more desirable. So that's the example that I use every year. So when you are working, you might need to buy the health insurance or death insurance. Not only because it's covered your, the death insurance is not only you leave something for you, the one who follows you, but it's for your tax deduction as well. And you must use IRR calculation in order to calculate which policy with death insurance policy is better. Again, you calculate IRR for different policies, and the one with higher IRR will be more favored. Example of IRR: as soon as a company is reviewing to project, management must decide whether to move forward with one vote or neither. Its cost of capital is 10%. Cost of capital is 10%, right? Hopefully you are still remember the cost of capital. Project A has initial outlay of 5,000, year 1, year 2, year 3 until year 5 has this return, while option B has initial outlay as 2,000 and the return of year 1 to year 5 is as shown. So option A, the figure gonna be like, the cash flow diagram gonna be like this. You have the year 0, 1, 2, 3, 4, and 5. You have initial investment of 5,000, right? And in year 1, you have return of 1,700, year 2, 1,900, year 3, 1,600, year 4, 1,500, and year 5, 700. Option B, you have this 5 year 0, 1, 2, 3, 4, 5. Initial outlay is 2,000. You have initial investment of 2,000, and then you have 400, 700, 500. You have 400, 700, and then 500, and 400, 300, and 400, 300. You want to compare these two projects, which one is better? Of course, you can use. You cannot use the. In fact, you can use present value or annual worth analysis as well. But in this case, let's use IRR. Calculate IRR for project A. So you want NPV equal to 0, right? NPV of option A is minus 5,000, right? Plus 17,000 divided by 1 plus I to the power of 1 plus 19,000 divided 1,900 divided by 1 plus I to the power of 2 plus 1,600 divided by 1 plus I to the power of 3 plus 1,500. Let me do this divided by 1 plus I to the power of 4 plus 700 divided by 1 plus I to the power of 5 and set it as 0. And if you use the calculators, you still use the Casio calculators, right? Anybody has a problem of solving equation using that kind of calculators? You can do it, right? You just plug in this type of equations and then let the calculator solve for the variable. My suggestion is you need to give them an initial guess as well, and you might give the initial guess as 0, that's fine. And you use your calculator, which I highly recommend you to bring to the exam room as well. And you will figure out that I is equal to 17% in this example. And option B, you use the same thing. NPV is equal to 0 and NPV is minus 2000 plus 400 divided by 1 plus I to the power of 1 plus 700 divided by 1 plus I to the power of 2 plus 500 divided by 1 plus I to the power of 3 plus 400 divided by 1 plus I to the power of 4 plus 300 divided by 1 plus I to the power of 5 equal to 0, and then you solve for I is equal to 5%. And therefore option A is the better options, right? Because the return is 17%. But in this example, it says that you can select both as well. You can have like either invest in A or B, or you can invest both of them, or you can invest neither of them. The answer is you invest only option A because IRR of option A is higher than your cost of capital, and your cost of capital is 10%. Because IRR of option A is higher than 10%, therefore you invest in project A. And you don't invest in project B because IRR of project B is lower than 10%. But if your calculation shows that IRR of project B is 15%, you still want to invest in project B as well because the IRR of project B is higher than the cost of capital. Any questions? Another example is you invest $1,000 now and have returned 315.74 per year for 4 years, starting in year 1. What is interest rate equate the future positive cash flow to the initial investment? Basically, if you are the cash flow diagram going to be something like this. So you have year 0, 1, 2, 3, and 4. You invest 1,000 here and you get 315.47 every single year for 4 years, and you want to find I. Because E is equal to A multiplied with 1 plus I to the power of n minus 1 over I 1 plus I to the power of n. Therefore, P is 1,000, right? It's equal to A, which is 315.47 multiplied with 1 plus I to the power of 4 minus 1 divided by I 1 plus I to the power of 4. You just plug in this equation into your calculators and you figure out that I is equal to 10%. want to do it in the harder way, you can do it like this as well. You can set NPV equal to, you can set like 1000 equal to 315.47 divided by 1 plus I plus 315.47 divided by 1 plus I to the power of 2 plus 315.47 divided by 1 plus I to the power of 3 plus 315.47 divided by 1 plus I to the power of 4. And you solve it, find I, you will get the same solution. Either way, gonna give you the same solution. Any questions? Another example is you invest $1,000 at time 0 and receive 5,000 at time 3 and 1,500 at time 5. What is rate of return of this investment? So simple, right? You have 0, 1, 2, 3, 4, 5. We invest 1,000 here. You receive 5,000 here. And you receive 1,500 here. So you set NPV equal to 0, and this is minus 1,000 plus 500 divided by 1 plus I to the power of 3 plus 1,000 divided by 1 plus I to the power of 5, and calculate I is equal to 17%. And one thing that I would like to emphasize is you need to be able to use your calculator in order to solve these equations that make your life is very simple. The last example of IRR is by investing 500,000 now, the company expects to save 10,000 per year for 10 years, additional 700,000 at the end of year 10. Determine rate of return by annual worth of this investment. So the timeline going to be something like this, right? You have 0, 1, 2, 3 until year 10. You initial investment of 500,000, 500K, and you saving 10,000 every year. An additional 700K here. Therefore, the 500,000 is equal to 10 multiplied with 1 plus I to the power of 10 minus 1 divided by I, 1 plus I to the power of 10, and plus 700 divided by 1 plus I to the power of 10. You see, because we don't know I in this equation, in this picture, basically you do the same thing. You draw a picture, you draw a cash flow diagram, convert everything to present value, leave I as variable, and solve for I, right? And that's what you need to do in IRR or rate of return analysis. And you will find out that I is equal to 5%. Any questions about the rate, initial rate of internal rate of return? What is a good IRR? That's the very tricky questions. It's no answer that how large IRR considered good. Whether IRR is good or bad will depends on cost of capital and the opportunity cost of the investor. For instance, a real estate investor might pursue a project with 25% IRR if comparable alternative real estate investment offer a return of 20% or lower. However, this comparison assumes the riskiness and effort involved in making this difficult investment are roughly the same. If the investor can obtain slightly lower IRR from a project that is considerably less risk or time consuming, then they might happily accept that lower IRR project. In general, though, higher IRR is better than lower, all else being equal. For example, I'm not sure that you guys are interested in investing in real estate or not. Like many of my friends do. Like they purchase a condominium flat and put it for rent. They might get return of 7% per year, 8% per year, given the rent is full throughout the year. Let's say 8% per year. 8% is quite good, right, for current investment. But another of my friends, he are more happy to invest in bond, even though it's returned only 5%. He has to save exactly the same amount of money. I have two friends that say, Mr. A and Mr. B. Mr. A is very interested in investing in real estate, condominium, with 8% per year. Given that he has the full rent for a year, he will get 8%. But another of my friends is Mr. B. He are interested in investment in corporate bond with 5% per year. He's more happy, given the reasons is that invest in corporate bond is less risk because he are not risking himself of finding the rent, the person who will rent his or her the apartment, as well as he has less effort to do so because every time that the rent change, my friends who own the apartment need to go there, need to like renovate the room, pay effort and time in order to do so and get 8%. But another friend is more happy with 5% lower IRR but much lower risk and much lower effort. Limitation of IRR: in the case of positive cash flow followed by negative one and then by positive one, IRR may have multiple values. Moreover, if all cash flow have the same sign, then no discount rate will produce a zero NPV. For the case that multiple IRR, we tend to ignore IRR that too large or too small. This is so general, like you already the like junior year, like you are junior year, third year, you're junior year engineering already. You see these equations, something like this. You see this equation. You will see that this equation is nonlinear, right? This is nonlinear equation, and that makes sense. That has multiple solutions, right? Because it's nonlinear equations. So that's the reason that I suggest you, in order to solve using your calculators, your calculator will ask you the initial guess and you put it the initial guess as 0 and that will give you the proper IRR. The IRR might have to, this is Excel calculation so we'll skip it, but this formula, this picture, this graph explain. So because it's nonlinear, it has two solutions here. And that's why in many times you found out that your IRR is ridiculously large and that the symbol that you are not calculating it correctly. I suggest you to recalculate it, put the initial guess at 0, you will figure out the correct IRR. Okay, I think that's all the heavy part of this lecture is gone already, so the remaining gonna be relatively easy. Payback period. So far we study how to compare different projects, right? We compare by present value, we compare by annual worth, we compare by IRR, and another method is payback period. Payback period is the length of time it takes to recover the cost of investment or length of time an investor need to reach a break-even point. Shorter payback period more attractive, while longer payback period are less desirable. The payback period is calculated by dividing the amount of investment by annual cash flow. It's very simple, something like this. So, you invest $1 million, it gives you 25 or 250,000 each year. So you invest $1 million, and it gives you back $250,000 a year. So you divided $1 million with $250,000 and equal 4. And this is your payback period. Your payback period is 4 years, meaning that you need 4 years in order to get your initial investment back. Downside of payback period. It's kind of like, I feel struggle a little bit when I teach payback period because it destroys all the time value of money principle that we have taught so far. And that is the downside of payback period. It doesn't account for time value of money, the effect of inflation, the complexity of investment that may have unequal cash flow over time. The discounted payback period is often used to better account for some of these shortcomings, such as using present value or future cash flow, something like that. But in this course, we cover only the simple payback period. It's very simple. Initial investment divided by annual return. When would the company use payback period for capital budgeting? The payback period will favor when company is under liquidity constraint because it can show how long it should take to recover the money laid out for the project. If short-term cash flow are concerned, a shorter payback period may be more attractive than a longer-term investment that have higher NPV. Payback period basically tell you that how liquidity flow in your organization or in your company, basically. I think this is the last one, is benefit cost ratio. The benefit cost ratio, BCR, is an indicator showing the relationship between relative cost and benefit of proposed project expressed in the monetary or qualitative term. If a project has BCR, benefit cost ratio, greater than 1, the project is positive. And if the BCR is less than 1, the project cost is outweighing benefit. So that's the benefit cost ratio. BCR is calculated by dividing the proposed total cash benefit of a project by the proposed total cash cost of the project. Prior to dividing the number, the net present value of the prospective cash flow over the proposed lifetime of the project, taking into account everything calculated. So the description is quite lengthy, right? So the example will explain everything. Assume that company ABC wish to assess the profitability of project that involve renovating an apartment building over the next year. So you have some project happen. The company decide to lease the equipment need for the project for $50,000 rather than purchase it. Inflation rate is 2% and the renovation are expected to increase the company annual profit by $100,000 for the next 3 years. So the picture gonna be something like this. You have this timeline. You have year 1, 2, and 3. You have initial investment of $50,000, i.e. is equal to 2% per year, and profit is 100,000, 100K. So you want to calculate benefit cost ratio. Basically, you want to calculate benefit first. Benefit of this project is basically 100,000 divided by 1.02 plus 100,000 divided by 1.02 to the power of 2 plus 100,000 divided by 1.02 to the power of 3, which gonna equal to 100,000 multiply with 1.02 to the power of plus I to the power of n minus 1 divided by 0.02 to 1.02 to the power of 3. This is gonna be equal to 288,388. This is benefit of implementing this project, and cost is equal to 50,000. Therefore, benefit cost ratio is benefit divided by cost, and this is 288 divided by 50,000, which equal to 5.77. And because benefit cost ratio is greater than 1, that means this project is very favorable. Any questions about benefit cost ratio? BCR are most often used in capital budgeting to analyze overall value of money undertaking new project. However, the analysis for large project can be hard to get right because there are so many assumptions and uncertainty that are hard to quantify. This is why there is usually wide range of potential BCR outcome. If project has BCR greater than 1, the project is expected to deliver positive NPV and will have an initial rate of return above discount rate in the discounted cash. DCF is discounted cash flow. This suggests that net present value of project cash flow outweighs the net present value of the cost, and project should be considered if BCR equal 1, the ratio indicates that NPV of expected profit equal to cost, and if it's lower than 1, the benefit is lower than cost. So that's all about introduction to engineering economy. So we cover many things, touch upon many concepts in engineering economy, and that's the big chunk of your final exam.